Jake Duroff here with the New Homeowner Center, and today I have my guest, Matt Berna with MGIC, to talk about mortgage insurance. Matt, thanks for being on.
Yeah, good morning. Thanks for having me. I appreciate it.
Yeah, so let's just start with kind of the basics here. What is mortgage insurance?
For sure. So mortgage insurance is initially geared towards protecting a lender if a borrower walks away or stops making payments on a home. That's how it affects the lender. But really, how it's going to affect a borrower is if you don't have 20% down, you're able to get into a home earlier, start building equity instead of paying money towards rent.
Okay. Can you go over just kind of a brief history and just kind of how it came about and that type of stuff?
Yeah, for sure. So MGIC, the company I work for, is actually the founder of the private mortgage insurance industry. We got founded 64 years ago in 1957. We're based out of Milwaukee, Wisconsin. Before MGIC and private mortgage insurance, the only way you could put less than 20% down on a house is if you were a veteran. Mm-hmm. Our founder came back from the war. He realized this and realized there was a huge market being missed. He pooled a bunch of money together. He actually got money off his barber. We have a really cool story on our website about it. But we started MGIC just backing people, knowing that people could make good payments, looking at their financial stability, their credit, whatever, and understanding that there's a better market out there for people to get into homes.
Okay. So why does someone need it then?
Someone needs it if they don't have 20% down, right? So you look at it right now, the housing market's going crazy. Values are appreciating like nuts. It's hard to get 20% down for a house. Mm-hmm. And you want to keep waiting and paying rent towards your landlord, paying their mortgage, or putting less down, paying mortgage insurance, getting in a house, and starting to build equity.
Yep. So I know a lot of people talk about mortgage insurance is quote unquote throwing money away, but the flip side of that argument is to not bring 20% down. So if you're trying to save up money to get 20% down, you are paying your rent monthly, which is again, quote unquote, throwing money away. And then the amortization of making those payments every month, and then the appreciation, you're missing out on that with when you're owning a home versus renting.
You got it. Let's say like last year was still a hot market for mortgage, and people last year were like, I want to wait. I'm gonna let things cool off. I'm gonna save up to get 20%. I'm gonna wait. Houses have appreciated almost 10 to 15% year over year. That's money you've lost. And while that's gone up, rent prices have gone up too. So not only did you lose out on all that appreciation you could have had in a home, now you're paying more for your rent, and it's harder to catch up to save that 20% down.
Yep. How is it kind of priced? Like what kind of are we looking at when you're getting quotes and stuff for mortgage insurance?
So anytime a mortgage insurance quote comes through, whatever loan officer you're working with, they're going to be the one who's handling the quotes. And what they do is they look at kind of your financial background. And when you think of a mortgage insurance quote, think of it just like you get an insurance quote for anything else. Your car insurance, homeowner's insurance, whatever you do. It looks at your profile of a person, your risk, your creditability. We're going to look at your credit score, your LTV, which is your loan to value. That's how much you're putting down versus how much your house is worth. Your debt to income ratio, which is how much you make compared to how much you how much you spend, and a couple other factors about the house. If it's a single family, if it's a duplex, there's a bunch of different risk characteristics that go into it to make a price that's unique to just you and your scenario.
Okay. So generally we're talking the longer the term, less you put down, and lower credit score, the higher the price of it is going to be.
You got it, right? So the less you put down, then it's the more that the lender is exposed. So that means that's the more your mortgage insurance premium is going to be. Just like if you put more down, let's say you put 15% down, then your mortgage insurance terms will be smaller. Then you'll also have to pay less because the coverage isn't as long.
Okay. So how does someone go about getting the mortgage insurance off their monthly payment?
That's the biggest question, right? Everyone's like, once they realize that mortgage insurance is a good thing, they're like, all right, how do I get the hell out of here?
Yeah.
And I get it. Obviously you want to get rid of it as quick as you can. And I will tell you, it's completely up to whoever is servicing the loan.
Okay.
So once a borrower goes through their mortgage deal with you, then they're going to be issued a servicer on that. The servicer is the one who kind of dictates the rules, but there's two kind of general rules that most people follow for canceling mortgage insurance.
Okay.
We're going to talk about original value here. That's the easier one to explain.
Mm-hmm.
So anytime you reach 78% loan to value of the original loan amount, mortgage insurance is automatically canceled.
Okay.
But with that, let's say, where was I going to go? Sorry, I lost my train of thought on that one.
No worries. So that's the original value is the 78%.
Yes.
And I know for what I do, when we're seeing home prices skyrocket right now, the way that we usually will get people to either get rid of their mortgage insurance or to get it reduced is using a refinance. If you bought just a couple years ago and the value of your house has gone up a ton, there might be the opportunity to get rid of the mortgage insurance because you have 80%. Less than 80% of the loan to value now, or maybe you put 5% down before. Now you have 10% equity, which will reduce your rate because you have a lower coverage percentage.
You got it. See, you saved me right there. That's where I was going to go. So the other option besides using your original value is using your new value, or current value, excuse me. So current value, right? You're talking about what the market appreciated. You want to see if your home's gone up, or maybe you've done an addition on your house that's added value. With that, you can get an appraisal done on your house to show the difference in value. And a lot of times the servicers on these are going to want to see at least 5 years servicing or seasoning, excuse me. Seasoning is time in that mortgage to be over 80%. If it's been, 75%. If it's been less than 5 years, they want to see 2 years, at least 2 years seasoning and be at least 80% LTV. So there's two different ways to go about it. There's more information on our website. It really does a better job explaining it than I just did right there.
Okay.
But the big thing to remember is anytime you're at 78% original value, so you go off that amortization schedule, automatically gone.
Yep. Yeah, I know that's the requirement of the servicer that they have to go and take that off there, which is a good value to people because a lot of people don't follow the value of their house and where their loan is at. So the servicer is doing a bit of a service there of eliminating it because they have to.
Yeah, definitely.
So a lot of people will be like, okay, is there a way that I can avoid mortgage insurance? And the only way that I could think of is bringing that 20% down because it is, providing a service. It's allowing you to buy a house with less than 20% down.
You got it. That's the key. Is if you want to avoid mortgage insurance, you put 20% down. But the thing is, if you look at it right now, you can borrow money at the lowest rates it's ever been, spread over 30 years. And let's say someone's going to use all of their savings to get that 20% down. Does it make sense to use all the money you have to get into this house? And then when you get in a house, what do you want to do? You want to buy furniture. You want to furnish it. You want to do other things. Do you want to borrow that money on a credit card at 25% interest?
Yeah.
Or take that over 30 years, borrow that 3, whatever it is. It's low, and use your money that you have instead. So, it's kind of like a financial, not financial gain, but like, you want to look at the right way to make sure you're doing things that work best for you instead of just trying to avoid mortgage insurance, which is probably going to be a pretty cheap cost monthly too.
Yeah. Yeah. Especially if you're doing a good job of, working on your credit, get in early when you talk to somebody to see where your credit's at, because even if you're thinking you're going to buy 6 months to a year out, get someone to look at it because you can make some improvements over that time, which will have a possibility of reducing your interest rate on your mortgage as well as the rate you're going to pay on the mortgage insurance.
And that's where it comes in handy working with a good lender like yourself, right? You sit down with them, you look at their financial plan, what makes sense, when are we planning on buying this house? You start the process early with someone, so when the time does come, they're set, they're in the best position they can be, and make sure that they get that house done.
Is making a monthly payment for mortgage insurance, is that the only option available, or are there other types?
There are other different types. Monthly is the most common one. You can think of it as like pay as you go, right? Just a monthly premium each month that's due. Another one that's popular is a single premium. So a single premium is taking that whole policy, the whole entire thing that you'd owe, and paying it up front.
Yeah.
And when you do that, you can either finance it into your loan amount, or you could pay it at closing. So there's two different avenues there. If you're real worried about what your monthly payment's going to be, you want to get that as low as possible, you can buy your policy outright up front, and then you don't have to worry about the monthly cost each time.
Yep. And on our side as a lender, one of the things that we'll run into with making that decision sometimes is your debt to income ratio. Sometimes you may have to do that upfront to be able to get under the debt to income ratio for your particular loan, because having that monthly payment is going to be too high, but maybe you have more available money funds to be able to buy that upfront policy.
Yep.
So it's just something that, you got to look at the pros and cons and what makes sense for your individual situation.
Yeah. But that's what you're there for too, right? You sit down, you explain to them the monthly versus the single. You find out which plan works best for them, what they're most comfortable with, and help them out. And a great loan officer like Jake is going to do that. He's going to walk you through the steps and make sure you're on the right path.
Yeah. So one of the things people probably have questions on a little bit is the verbiage. So PMI, mortgage insurance, some of the other vocab for what you do. Could you just kind of explain what everything is just a little bit?
For sure. So PMI, MI, same thing. Mm-hmm. Where you're going to see a big difference is when you start hearing FHA, VA, USDA. Mm-hmm. So we're going to think about it in two kind of buckets again. Conventional loans are ones that are going to have PMI on it, private mortgage insurance.
Yep.
Ones that are government backed, that's going to be a USDA loan or a VA, Veterans Affairs loan, or FHA, Federal Housing Administration. Those loans have mortgage insurance, but it's not private mortgage insurance. There's a difference there.
Okay.
Conventional ones where you do it, you can get rid of your mortgage insurance on that. On the government side, you cannot. Those are there for the life of the loan.
Okay. I think that's all the questions I have for you here. Is there anything else you wanted to share before we go?
Yeah. One other thing I want to say is we have some really good consumer tools as well. We have a website that's out there that's geared towards people getting ready and understanding the mortgage process. Okay. There's articles on there of people, how they bought their first house. There's calculators to see. You can compare how much you can afford if you want to wait and see how much homes might appreciate. There's lots of really good stuff. That website is readynest.com.
Okay. Yeah. So readynest.com is a good resource if you want to learn more things about mortgage insurance or any other, process of buying a house.
Definitely. I'd say reach out to your lender, reach out to Jake, get something going. He's a phenomenal resource. He's going to help you out.
All right. Well, thank you very much for being on, Matt.
Yeah, I appreciate it. Thank you.